These next sections of tests all talk about multi-factor models. So the idea is, let's take the information that we learned from our tests of CAPM. So these are going to be based on 2 past regressions, once where you estimate the impacts and then another time where you test it. And they're going to be focused on saying, okay, well, we realize that the market isn't perfect, so let's see if we can augment what we use to define the market so that we can capture more things. That's the first thing that you're seeing in this model by Chen, Roll, and Ross, which is called the macro model. What they're trying to do is say, well, maybe we're missing parts of the market that haven't been fully priced in, and that's why when we're running CAPM regressions in general, our slope was found to be too flat. So let's see if we can include those. The next few models that we're going to discuss focus on some of the anomalies that we discussed in chapters 11 and 12. So recognizing that there are some things that we consistently see happen in the market, some behavioral-based patterns and some puzzles like the high minus low, small minus big things, and let's see if we can price those in. So in this first one, we're looking at additional things that can augment the market, so macro-level market conditions. The first one is growth in industrial production. Is industrial production increasing? If it is, then that's general growth in the economy. That let's focus on that instead of just looking at RM as a whole. Then changes in expected inflation. So do we expect, if we expect inflation to go up, that should be priced into the market, but what if it's not yet? So let's add that on as an additional factor. Then unexpected inflation that might come up, unexpected changes in the risk premium on bonds, and then unexpected changes in the term premium on bonds. So the risk premium on bonds, what they're talking about there is the difference between the yield on a treasury versus the yield on a AAA rated bond. So how much extra is that coupon rate for the amount of risk that you're bearing? That's what a risk premium is. And then a term premium is the idea that longer term bonds always require a higher interest rate. So what is the difference in the coupon rates that you're getting there? Now, when they go ahead and test this, they test it using the 2-stage model. So use one chunk of data to estimate the betas, and then use the second chunk of data to go ahead and see what the impact is. And they end up finding that industrial production, the risk premium on bonds, and unanticipated inflation are statistically significant. So meaning that they do have value, that they do help to predict changes in the market. But interestingly, when they did this, that regular RM, that market index, was not statistically significant. Now, you understand what it means to be statistically significant. That's when the alpha value is above 0.05, right? So these are just running a regular regression and seeing what happens. There's a couple other econometric tricks that they pulled in there, but that's the basic idea. So it's something that you guys are familiar with. The next kind of models are the FAMA French models. Those are picture of FAMA and French. So they had their classic 3-factor model, which used the excess return on the market, so the market risk premium, RM minus RF, right? Just like you would have seen in your single index model. Which is our application of CAPM, and then accounting for 2 quote-unquote puzzles that we've seen in there. The fact that firm size seems to have an impact, and book-to-market value ratios also seem to have an impact, so small minus big and high minus low factors are included in there. That was the initial FAMA French 3-factor model, and then as I talked about in one of the chapters, I believe chapter 11, that there is now a 4-factor model where where momentum is also incorporated in there. So do these work? Yes. These have been shown to work. Here's a general CAPM fit plot. This is from their FAMA French 1993 paper. So we can see here, this is predicted return from CAPM as a percent per month versus actual, and they're plotting along there, you can see here that when we include the FAMA French 3-factor models in there, the regression line fits a little bit better. As you add momentum, it fits a little bit better. And now there is a 5th factor that I'll also show you that will cause it to fit even better. Now, some are going to argue that momentum works better in different time periods, that high minus low works better in different time periods, and that's true, but the point is we are still progressing in our understanding of how to more accurately model, and the more accurately we can model the risk-return relationship, the more accurately we can determine if a stock is a good buy or a bad buy. So remember, when we're doing this, the entire purpose is to say, should I add this into my portfolio? Think back to 345. You had a stock that, according to CAPM, was predicted to return 11%. That's the risk-based return. And then they expected to return 13%, right? So if they expect to return more than is predicted, then they would have a positive alpha value, right? They would add value. They are earning more than their required rate of return based on their risk. So that would be something you would want to include in your portfolio. The more accurately you can predict their risk-return relationship, the more accurately you can determine if that stock does have a positive alpha or a negative alpha. Therefore, whether you do want to include this in your portfolio or not. The next models are going to be risk-based interpretations. So in our first section here, we see the note, style seems to predict GDP growth and relates to the business cycle. So the idea here, when we're saying style, we're saying the HML or SMB. So high minus low or small minus big, if which section they're in, that relates to the business cycle. So they seem to predict GDP growth and thus may in fact capture some aspects of the business cycle. Each bar is the average difference in returns of HML and SMB portfolios in the year before good GDP growth versus in the years with poor GDP growth. Positive values mean the portfolio performs better in years prior to good macroeconomic performance, and the predominance of positive values leads them to conclude that the returns on the HML and SMB are positively related to future growth of the macroeconomy. And maybe proxies for the business cycle. So you're all familiar with the business cycle from your macro classes or your econ classes. We know that the economy in general grows and contracts over time in a cyclical pattern. So we understand that there are times of economic growth and prosperity, and then there are times of recession, and then it moves in a cyclical pattern. So this is saying that cycle may be able to be predicted by the returns from these different style portfolios, which is kind of interesting. The next paper, which I believe is one that one of you guys will be presenting, also tries to tie this in. So it says, when the economy is expanding, they find that value betas underperform growth betas, and when the economy is contracting, when it's in a recession, value betas are greater than growth betas. And that's what we're seeing in this picture. So they try to tie the average return premium on value portfolios to risk premiums, and their approach is based on conditional CAPM. So if a stock's beta is high when the market premium is high, this is positively associated with a synergy in its risk premium, which is a product of beta and the market risk premium. They note that firms classify as value firms, which are ones with high market-to-book ratios, on average, have a greater amount of intangible capital, a greater amount of things that are hard for the market to fully price, and maybe that's one of the reasons that this is going to be happening. So investment irreversibility puts some firms more at risk for economic downturns because in a severe recession, they can suffer from excess capacity of assets that are already in place. In contrast, growth firms are better able to deal with a downturn in economy by deferring their investment plans. So If you're in a growth stage, you're saying, okay, well, I don't necessarily have to invest in this right now. I can hold off. Versus when you're in you're a value firm, you're already huge. You're already overly invested in these things, and it becomes harder. The greater the exposure to market to book firms to a recession will result in higher down market betas. Some evidence also suggests that the market risk premium is higher in down markets when the investors are feeling more economic pressure and anxiety. So the way they tested this, and you can see their regression down here, they used the market dividend yield, which is the DIV, the default spread on corporate bonds, so AAA versus BBB, the term, which is the term structure, the 10-year to 1-year Treasury spread, and then the 1-month T-bill rate, and that's the model that they estimated, and they support the notion of a counter-cyclical value beta, meaning that the beta of an HML portfolio is negative in good economic times, so that the beta of high-value firms, high market-to-book, is less than that of growth firms. Growth firms have low book-to-market. But the reverse is true in recessions. While the covariance between HML beta and the market risk premium is not significant, or it's not sufficient to explain it by itself, the average return premiums on value portfolios, it does suggest that at least part of the explanation may be a rational risk premium that is coming into here. So now we're seeing the cyclical impact, and so this is saying that the betas have this additional information, and it's going to be dependent on what type of firm it is, whether it's a small minus big, HML or an SMB, right? That's their style that they are discussing there. The final section of papers that I have you guys talking about, there's 2 more, how to price in liquidity, and also something called consumption-based CAPM. So one of the papers you're going to be doing is saying, all right, well, there's another factor that might not have been included in here. So we talked about why the FAMA French factors have an impact, because that's a style. It's a high minus low, small minus big, the type of firm that it is, if it's a value firm versus a growth firm, and that can have an impact. But what about liquidity? So liquidity involves trading costs, ease of sale, market depth, price predictability. So here's CAPM plus a liquidity premium, and here's the FAMA French plus a liquidity premium. So when a liquidity beta is added in as an additional factor, even above the traditional FAMA French 3 and 4 factor models, that also has an impact. So maybe we should price in some measure of liquidity. And then the literature is arguing about what is the best liquidity measure. Is it just an ease of sale? And how do I measure ease of sale? Is it trading costs? Well, obviously, if there's higher trading costs, it's less liquid because you have to pay for it. Is it market depth? How big the market is? Is it able to make all of the sales that it needs to make? Those kinds of things. And then the final one is something called consumption-based CAPM. So with consumption-based CAPM, you're following the general logic of CAPM, but now you're saying that an investor isn't really concerned with just their wealth per se, but they're more concerned with their lifetime consumption. So the model is derived from lifetime consumption investment plan for a representative consumer or investor. Each investor's plan is set to maximize their utility, but not just the utility of wealth anymore. Now it's the utility of lifetime consumption, and then the consumption investment decision is made each period based on their age, their current wealth, and the risk-free rate of return and the market portfolio. So each period, you're making a decision. This is how much money I have. How much should I use to consume, meaning buy stuff, versus how much should I invest? So there are different periods of your life. Like right now, I have to spend a lot of money, usually in daycare and things like that, right? So I don't have so much of my money that I can be saving, which is kind of ironic right now. Now I'm still paying for the daycare that we are obviously not getting due to the quarantine, but that's life. Okay. So now the impact of this is that it's not just how your stock reacts to changes in the market. So this is saying a measure of risk as the covariance of returns to aggregate consumption, meaning that the beta isn't just about how does your stock react to changes in the market, it's also relative to your degree of consumption. So A is dependent on the average covariance of risk aversion, and RC, which is the rate of return on a consumption tracking portfolio, constructed to have the highest possible correlation with growth in aggregate consumption. I think one of you is presenting a paper based on this, but by and large, the tests have found that consumption-based CAPM really doesn't do any better than regular CAPM in explaining risk premiums. There's still an equity premium puzzle that refers to the fact that using reasonable estimates of A, the covariance of consumption growth and the market index is too low compared to the historical averages that we would expect. So I believe the paper you guys are going to do focuses on year-over-year fourth quarter consumption and employs a FAMA French style model of consumption-based portfolio tracking. The factors that they look at associated with consumption-based CAPM, as well as excess returns. And they're also going to consider the size effect. So the book-to-market effect is going to be involved in there. And they end up showing that consumption-based CAPM does explain returns better than just the three-factor model, which is in turn superior to just the single factor or single index model, which is our application of CAPM. Standard consumption-based CAPM focuses on a representative consumer, therefore ignores information about heterogeneous investors with different levels and habits. So if you really can focus in on an individual investor's consumption plans, then that might be an additional factor that you could put in there to help bolster your model.